Thank you so much for joining me. Welcome again for this for today's session. My name is Wafula Joshua. I handle advanced financial management and public finance at all levels at Regional College, Commonwealth House, 5th floor, opposite Galitos. We offer both online and physical classes, so be free to join us to help you conquer this the CASNEB exams. The intake is ongoing. Feel free to contact us. Our numbers will be shared in the video that we are having today. Now, today I want us to talk about advanced financial management again. The question that was tested in May 2021. May 2021, that was a question on investment decisions, question 5C of May 2021. So we are having May 2021, question 5C. May 2021, question 5C. Let's go through it together and we see. We are told that ZTech Limited wishes to design a new product so as to catch the interest of their target market, which is currently very competitive. The company will have to invest 100,000 shillings at the beginning of the first year. Beginning of the first year, that is initial outlay, year 0. You're investing 100,000 for the design and model testing of the new product. No problem. The company's marketing manager believes that there's an 80% chance that this phase will be successful and the project will continue. So 80% chance of being successful and the project will be continued. If phase 1 is not successful, the project will be abandoned with zero salvage value. So it can either succeed or fail. If it succeeds, there's 80% probability. If it fails, 20% probability, salvage value will be 0. The next phase, if undertaken, would consist of making the molds and producing 10 prototype products at a cost of 500,000 at the end of the first year. Remember, it has to be successful in the first phase before it goes the second phase. So the success of first phase identifies or considers or actually ensures that phase 2 is realized, or we got phase 2 in simple terms. So we're told that the 10 prototype products at a cost of 500,000 at the end of the first year. If the products test well, the company would go into full-scale production. If they do not, the molds and prototypes will all be sold for 400,000. The manager estimates that there's a 90% probability that the products will pass testing and phase 3 will be undertaken. So if it passes phase 2, phase 3 will be undertaken. If it fails to pass through phase 2, then you shall be able to sell them and get the 400,000. Phase 3 consists of changing over the firm's current production line so as to be able to produce the new products. This will cost 1 million at the end of year 2. If the economic conditions are favorable at this juncture, the net value of the firm's cash flows are estimated to be 3.5 million. While if the economic conditions are unfavorable, the net cash inflows are estimated at 2.5 million. Both net cash flows are expected at the end of year 3, and the two states of economy are equally likely. Equally likely, that is 50-50. 0.5, 0.5. Opportunity cost of capital is 11%. Construct a decision tree to depict the payoffs, hence determine the expected NPV of the project. Now, the decision tree, we all understand that we have the decision variable and we have the conditional payoff. Decision variable is a square or a rectangle which identifies the decisions that you are going to make. Independent decision. Conditional payoffs is actually the result of the decision that you made. An oval. So, it is always consistently arranged. We start with the year 0. The company will have to invest 100,000 shillings at the beginning of the first year. So the decision is not whether to invest or not. They are going to invest 100,000. You can put it in thousands of shillings per leju. 100,000 at the beginning of year 0 for the design and model testing of the new product. The company's marketing manager believes that there's an 80% chance that this phase will be successful. So it can either succeed, or what? Or fail. Succeeding is 80% chance, meaning failing is 20% chance. When it succeeds, the next phase, so we're told that if phase 1 is not successful, the project will be abandoned with 0 salvage value. So here, we'll be able to abandon it. The payoff will be 0. The next phase, if undertaken, would consist of making the molds and producing 10 prototype products at a cost of 500,000 at the end of the first year. So after succeeding in the first year, we make another decision to spend 500,000. It's another decision that you are making there. The cost will be 500,000. If the products test well, the company would go into full-scale production. So they can either test well, or you can say test bad. If the products test well, the company would go into full-scale production. If they do not, the molds and prototypes will be sold for 400,000. So if it tests bad, we are going to sell and realize a cash flow of how much? Of 400. That is cash coming in. So it's a payoff. As a result of what you are going to sell, we have the payoff for 400,000. The manager estimates that there's a 90% probability that the products will pass the testing. So passing testing is 0.9 and this one is 0.1. Then we got phase 3. So if it passes phase 1, this is phase 1, phase 2. If it passes phase 2, it goes to phase 3. Now in phase 3 consists of changing over the farm's current production line so as to be able to produce the new products. This will cost 1 million. So here again, we spend another 1 million. It's a decision that we are making. At the end of year 2, if the economic conditions are favorable at this juncture, the net value of the farm's cash flows are estimated to be 3.5. So the conditions can either be favorable or unfavorable. So either favorable conditions or unfavorable conditions. So if the conditions are favorable, the cash flows are estimated at 3.5. Remember the cash flows, that's the conditional payoff, an outcome of the decision that I made. If it's favorable, I get a cash flow of 3,500. If unfavorable, I get 2,500. And you're told that the two states of economy are equally likely, meaning 0.5, 0.5. 0.5, 0.5. And the cash flows, both net cash flows are expected at the end of year 3. So therefore here, I can appreciate that I have the year here. This can be year 0, year 1, year 2, and year 3. The figures in thousands of shillings. In thousands of shillings. So meaning, if I sold at 400,000 in year 3, I'll be able to get nothing. If it failed in the first phase, then I get nothing in year 2, I get nothing in year 3. The total probability here is 1. So they wanted us to construct a decision to depict the payoffs and hence determine the expected NPV of the product. So let me get the joint probability, then I'll get the NPV. Joint probability. So for the joint probability, we are joining all these items. We're joining also, it's 0.8 times 0.9 times 0.5. So it is this and this and this. So having 0.8 times 0.9 times 0.5. We're having 0.36. The other one is 0.8 times 0.9 times 0.5 is also 0.36. This other one is 0.8 times 0.1 times 1, I believe is 0.08. And this other one, 0.2 times this times 1 times 1, I'm having 0.20. I feel the total should always be 1. And notice that should always be the case. Total probability is 1. Now the NPV, let me have here a working to show the NPV. Like the first one, these are the cash flows of year 1, cash flows of year 2, cash flows of year 3, and we have the initial outlay. Cost of capital, as we were told from the cost of capital, it's 11%. So NPV at 11%. Like the first one, we are having negative 500 times PVIF, 11% 1 year, plus negative 1,000 times PVIF, 11% 2 years, plus 3,500 times PVIF, 11% 3 years. We subtract the initial outlay of 100. When you check in our discounting tables for the lump sum table 1, 11% 1 year, so we are having negative 500 times 0.9009 plus negative 1,000 times 0.8116 plus 3,500 times 0.7312 minus 100. So I get which answer? Let's work it out. So you're having negative 500 so negative 500 times 9009 sorry, plus negative 1,000 times 0.8116 plus 3,500 times 0.7312. Then we subtract 100. We subtract the 100 shillings, the initial outlay. I'm seeing 1197.15. So 1197.15. That is the first NPV. The second NPV, 500 times 0.9009. So 500 times 0.9009 plus we are having 400 times 0.8116. 0.8116. Sorry, the second one is 1,000. So 1,000 times 0.8116 then you are having plus 2,500 times 0.7313. So that one equals minus 100 that we have, we get 466.2. The third one, you are having 500 negative times 0.9009 plus 400 times 0.8116. So this other one is 0, so that one minus the initial outlay of 100, we are having negative 225.81. Then finally here, there's nothing, so you have negative 100. Negative 100. So therefore, our expected NPV becomes here. Expected NPV. Kindly note that our expected NPV from here equals the summation of NPV times joint probability. Summation of NPV times joint probability. So therefore, we are having our summation. So this times this, plus this times this, plus this times this, plus that times that, we get our expected NPV there. So we are having 0.36 times 1197.15 plus 0.36 times 466.2 plus 0.08 times negative 225.81 plus 0.20 times negative 100. So you're having an amount of 560.74. 560.74. So that brings us to the end of part 1 of that question. Brings us to the end of part 1 of that question, which was asking about the expected NPV. So the payoffs, and hence determine the expected NPV of the project. Now, part 2, the project's expected standard deviation and coefficient of variation. Now, to get our standard deviation, allow me to wrap this one. To get the standard deviation, we know that standard deviation equals to square root of variance, and our variance is the summation of NPV minus expected NPV squared times the probability. So we are having the first NPV is 1197.15 minus expected NPV of 560.74 squared times the probability of 0.36. Plus the second one, we are having 466.2 minus expected NPV of 560.74 squared with a probability of 0.36. Plus the third one, we are having a negative 225.81 minus 560.74 squared with a probability of 0.08, then plus negative 100 minus 560.74 squared times 0.20. So let's have that. We see what happens. So the answer is what we do the square root of it. So you're having 1197.15 minus 560.74. We are having squared times the joint probability of 0.36 plus 466.2 minus 560.74 squared times the joint probability of 0.36 plus negative 225.81 minus 560.74 squared with the joint probability of 0.08, then plus negative 100 minus 560.74 squared times 0.20. 820. So we are having the square root of 285, 832.322. So you need to get the square root of that. So equals to, so the square root of 280 of the answer, 285, 832.322. So we are having 534.63. That is our standard deviation. And after the standard deviation, they wanted us to get the coefficient of variation. Coefficient of variation equals to standard deviation over expected NPV. It measures risk per unit of expected NPV. So our standard deviation is 534.63 and the expected NPV was 560.74. So you have it there, so divide by 560.74. So that is 0.953. That is our coefficient of variation for 5 marks. Then finally, assuming the firm's average project had a coefficient of variation of between 1 and 2, explain whether the project would be of high, low, or average risk. Now, as far as risk is concerned, to measure the risk, the lower the CV, the lower the risk. When an average project has a coefficient of variation of between 1 and 2, and so we compare the average project is between 1 and 2, but the coefficient of variation of the project is 0.953. So because 0.953 is less than between 1 and 2, so for that reason the project is less risky. The project has a low risk. So in conclusion, we say that the project has a low risk. That is what was expected of us in that question. That is what was expected of us in that question. And again, I thank you so much for joining us, and I hope the lesson has been interactive enough. And we thank you for that. Continue subscribing to the channel so that it can be able to reach many people, so that they can also benefit the way you are benefiting from this knowledge that is being offered for free. Thank you so much, and God bless you.